Good afternoon. This is Ken Long from Tortoise Capital with a review of the daily trading plan for April 30th, 2011. We have a bullish normal market condition. On an annual basis, weekly RSI, it's at the very high end of neutral, 70, ready to go into overbought. On a 10-day index, a short-term look back at the market, it's at 98 on the weekly, or on the NDX 10, excuse me. So we're overbought on a short-term basis. The percent stretch above the 200-day moving average is at 12.35%, which is bullish, although not as powerful as it has been. The slope of the 50-day moving average has improved slightly to 0.22%, but it's still in the red and therefore bearish when compared with the last 6 months. ADX 14 is at 15.5, so we've moved back up into neutral, and with plus DI greater than minus DI, as you can see in the lower left-hand corner, that is a favorable indicator for a possible bullish third leg up in this bull market. The ATR percentage at 0.92 remains just slightly under the average for normal compared to the last 180 days, and that's favorable for the long side. Looking at the gap stat over the last 30 days, we have 12 times in the last 30 the market has gapped down. Half the time it reversed to close higher, for an average follow-through of 0.53, and then on the 6 days where it failed further, it only averaged 0.11. So definitely the gap down and reverse is the favored position to take with the best follow-through of any of the gap conditions. 18 times the market has gapped up in the last 30 days. 8 times it's reversed to close lower for an average of minus 0.38. 10 times it's gapped up and then continued to go for an average additional follow-through of 0.29%. And so the relatively bullish moves of the last 30 days definitely favor the long side on the intraday trade. You can see the time series of the 10-day index. We are and have been for a while now overbought. The largest average normal move in the SPY intraday from low to high has been 1.55%, the range stat being the average plus one standard deviation, so 1.5% inside SPY. No signals in the overreaction or channeling, and you can see the pivot point key price levels. On the 10-day max pain, Bank of America, Microsoft, Home Depot, Hewlett Packard, and AT&T, and among the ETFs, the VIX, the dollar up, silver, China, and agriculture, the Deutsche Bank Agriculture Index. Only a very few patterns firing and VIX for the 5-day down, and then you can see the 30-60 stealth candidates. These are, and the modified French momentum. These are symbols that are have a kind of a stealthy improvement over the intermediate term time frame. Looking at the Dow Tactical, we have Home Depot on a channeling, and you can see the usual suspects for the max pain range compression being led by Bank of America, Home Depot, Coke, Verizon, and Hewlett Packard. Among the ETFs, only a few dojis, no patterns to speak of, and the VIX has been so horrible that nothing else comes even close in terms of maximum pain. But max pain range compression, looking at the VIX, Deutsche Bank Agriculture, Latin America, Treasuries, and gold. Slope of the 30-day regression line is still up. The R-squared at 0.60 is actually becoming more confident that the trend is upward. As we've seen, the last 10 days have been very favorable. The slowdown in the improvement of the last 4 or 5 days has brought the slope line closer to its 10-day moving average after a 2 standard deviation move off the bottom down around here at 128. And you can see this percent stretch above the 200-day moving average has put it right at the boundary of 1 standard deviation above average, which is the boundary to get it into green and an exceptionally strong move. This still looks favorable to me. The higher lows in that indicator plus the potential to get as far up as 2 standard deviations suggests there's another 5 to 10% available on the next leg up if it can continue to build on the success of the past 7 or 8 days. The range stats for all the usual suspects in the ETFs and the Dow 30 you can see as for reference here. and then the gap statistics for the large cap and broad-based ETFs. The safe zone channel, SPY, has come back into its own safe zone channel here, but it's on the upper end of that channel, so this is still favorable. 30-60 quality in the Dow. Again, I like to look for red in the 31 to 60, followed by yellow or white, and so I'm looking at Microsoft, Cisco, Walmart. Merck has already had such a powerful move that there may not be anything left in it. However, certainly you could look at that one as a candidate for additional momentum on a daily basis. Among the ETFs, looking at technology, Asia less Japan, and the Euro-Asia blend, all were red 2 months ago and have gone into the white 1 month ago. The diamonds are of kind of interest to us here, and not they weren't that horrible, but the powerful move at 4.96 for system quality the last 30 days gives it a really favorable 30-60 divergence, and we're seeing that reflected in the defensive sectors like staples and healthcare to be leading the way inside the U.S. The 30-day relative strength score, you can see just how harshly the technology has rolled over. A lot of that I attribute to rebalancing of indexes with Apple and then some earnings disappointments in Microsoft, but I consider Microsoft to be a good candidate for stalking even so. In the elder safe zone, only Japan and gold fired as increasing the strength of their signal on Friday, and I take that as a favorable positioning for gold. It may be ready to start resuming its leadership role, with silver starting to look a little toppy. These are the top 15 winners and losers by the various time periods and what they turned in on a percent performance on Friday. And you can see the momentum winners are highlighted in green by both. And the daily, weekly, and monthly pivots for all the usual suspects among the ETFs and a handful of large caps I'm always interested in. And the holding X-day period, you can see the predominance of green just says that this has been a broad market-based recovery here, with the only real exception being Latin America. As you can see, that's a little bit in the red, and Japan suffering a little bit still on the 40-day holding, but even now it's back under one standard deviation on the downside. So Japan is definitely returning back to normal, and thank goodness for them. Correlation coefficients, biggest distinction being Japan out of sync with every other regional index due to the disaster and the response to it. And that's a quick review of the trading plan. And this we'll want to proceed right into charts of interest. And we have Alcoa finding some resistance here at around 17 by the 200 and also the 50-day moving average. If it can hold here above 16.5, I see a retest of 18.5 being definitely feasible. Boeing is leading the way out of the sell-off in this consolidation period, and it's voted up pretty strongly in the last 2 days. I'd look for continued momentum there. Caterpillar, potential evening star doji, but if it breaks north of that previous high, then that could be a resumption of the leadership trend that it has experienced. Cisco found support here around 17.25. If it can break out of 17.5, we may finally get to see Cisco starting to lead its way and lead the techs back up to 18.5. Chevron remains solid in the energy sector. DBA at the bottom of a sideways channel that has lasted almost 2 full months. I see 33.5 as a pretty important support level, and you had 1 day of success on Friday. I'd be looking to be long north of 34 with an idea of trading it to 35, and then if it gets through there all the way up to 36. Blended commodities are pushing at the top end of their channel. If they can break north of 32, that's going to be very favorable. EFA has been stronger than the U.S. lately, and some powerful moves off this bounce at the 50 and the 200-day moving average. That looks favorable. Asia less Japan had been a strength leader on the basis of this late May and early half of April move up. It is stalling at about 51. and so I'd be looking to preserve those profits, but also ready to reward any resumption of that strong move north of 51. Brazil, much like the rest of Latin America, has been suffering, and that's been the index that has been lagging the most. It's got to get north of 79 here so it can break out to retest the previous swing high. Hewlett-Packard has really been going nowhere, nothing but sideways. The good news is that it has failed to fail any further, and so if 40 can hold as a support level when the rest of technology starts catching up, Hewlett-Packard has some room to go. And you can see the weakness in Latin America, much like Brazil. Looking now at the second half of our charts of interest. Let's raise it up just a little bit. There we go. We have Intel, definitely a key leader in technology, and you can continue to reward success here. It has blasted through previous resistance very well. The small caps doing very well also, broke through 86 and have an unlimited future ahead of them. Johnson & Johnson and Kraft, really Coke and McDonald's, all of those, with the exception possibly of Coca-Cola, have really been leading the way for the large caps in the U.S., and that's where that strength in the Dow Jones 30 is coming from. Microsoft looked like it was making a move, sold off pretty harshly when they, for the first time in memory, their profit was less than Apple's, and that accounts for the one-day sell-off. But it did hold at the 50 and the 200-day moving average. If it can shake that off, I think we have a really excellent tactical trade setting up in Microsoft. Silver starting to look a little toppy. We had a one-day pullback followed by some vigorous buying. However, it didn't really close north of 48. It has to get through that 50 will be an important psychological barrier. But it's silver's been looking toppy here, and so I would not be overweight silver anymore, but I would be ready to pile back on if it gets some momentum north of 48. Oil back up to a previous swing high, and it's got to prove it's got to get north of 45. VIX has just sold off into a 5-day down with a support level around 23, while Walmart, like the rest of the staples, continues to march north of 55, and you can reward momentum there. And I'd be looking at those four horsemen right there. Walmart, McDonald's, Johnson & Johnson, and Kraft is the easy winners on a flight to quality among the large caps. So that's Ken Long from Tortoise Capital with charts of interest. We're off to the soccer game to play for the championship this afternoon. And go Leavenworth Thunder, the mighty U12 girls team from Leavenworth, Kansas, in the finals of the Challengers Cup. Go get 'em Thunder.